Very pleased to be with you today. Exciting event. I'm going to tell you a bit about Funding Circle and what we do in the field of data science, which is very much the area I'm in charge of at Funding Circle. So hopefully you find that interesting. I'm going to go through a presentation, and at the end, we'll have a bit of time for some questions if you want. So the story is about lending to small businesses. And I think it starts with those experiences where I'm sure you've all been through that, where you're thinking, I can't believe it is that bad. We all experience that, right? Someday you use a service, you expect something because you're used to, as a consumer, to have a very sleek experience with Amazon or Netflix or whatever. And you stumble on something which is absolute rubbish. And if you are an entrepreneur today in the UK, in the US, in Germany, pretty much everywhere in the world, and you want a loan, that's typically the kind of experience you get. It's complete crap. And I just couldn't believe that it has to be so bad. I've spent my career doing in financial services, supported by a lot of analytics, selling credit cards, mortgages, bank accounts, you name it. And the experience is OK, right? You go online, you want a credit card, it takes 2 minutes. That's OK, right? It works pretty well. Why is it that when it comes to small businesses, it's terrible? It's absolutely terrible. And it's a big issue. So we're going to talk about how we're solving this issue today, because this is a very important issue for the society. It's not just about having a good product. It's about helping the economy as well. That's what Funding Circle is doing. So just for those who are not fully familiar with small businesses is huge, right? Well, it's not this tiny thing in the corner. It's the economy, right? Pretty much everybody at some point works for a small business or has somebody in his family running a small business. That's what the world is made of, right? We always talk about the big companies, but people don't work in big companies. They work in small businesses. That's the real economy. In the UK, 51% of all private sector jobs are in small businesses. 16 million people. It's huge, right? There are different types of small businesses. You can be a limited company. You can be self-employed. You can be in partnership like a lawyer or a doctor. There are different ways to do it. But at the end of the day, you are an entrepreneur. You have a small company, employees, no employees, but you're just small. And you create a lot of jobs. So if small businesses can't access finance, it's the whole economy that is slowing down. It's a major problem. And if the economy goes down, what happens? People are very unhappy. And then guess what? They start voting for populists. It's a big issue. So solving for small businesses accessing finance is very much about solving for the society to work better. And the good thing is data science can help. So what's the problem? Why is the process to give a loan to a company so bad, typically? Well, because it's complicated. And it's complicated due to the nature of the entities you're dealing with. Small businesses are very diverse. You can be a plumber, you can be a shopkeeper, you can run your little factory, you can be an architect. These are very different people. They have different needs, different background. It's quite hard to understand them all. And if you are a bank and you try to underwrite loans in a safe way towards such a diverse audience, it's complicated. How are you going to standardize that stuff? It's hard. The other thing is, if you think about a small business, the kind of risks small businesses are exposed to are also multiple, and they are connected. So think about whether the small business is going to succeed going through the phases of growth, from a startup to a more established company. So many things can happen, right? You could stumble on. Think about the industry you're part of. Well, if you are in transportation industry, or if you are exporter or importer, you're subject to variations in FX, movement in change in regulation. So many things can happen that could kill a small business. Think about the owners of the business. If the owner is sick, the business might just die, right? So it is a complex set of problems that small businesses deal with on a daily basis. And so it makes it complicated for lenders to understand how it's going to play out. When you give them money, are you going to get the money back? Which is the big issue banks are trying to obviously protect against. And then the other thing is small businesses don't just need very small tickets, right? Many companies need to borrow 100,000, 200,000, £1 million. It's not tiny, right? If you get it wrong, for the balance sheet of a bank, it's a big loss. So complicated, diverse, big risk, scary, right? So what have banks done against that? Well, they put a process in place which protects them, right? So focus on big companies, easier. Make sure they all have a bank account with you, because then you can track what's going on, plus you make more money. Ask for lots of papers, right? Ask for everything you can think about, so that you can't miss anything. In particular, ask entrepreneurs to put together a business plan each time they want money. So you want £100,000, tell me what you're going to do with it and how it's going to impact the cash flow of your business in the coming 3 years. Well, if you run a bakery, what the fuck? You don't know what a business plan is, right? You don't know how to use Excel. You don't have time for that, right? You like to bake cakes, right? Your job is, you're not like an accountant. And if you need to hire an accountant, it's going to cost you a fortune. So it's a no-go. They're going to impose security. So usually they only lend if you accept to secure the whole business assets against the loan. So that if you fail, they can just take your assets and get the money back. That's easy, right? That's easy lending. But what if you don't have assets? What if you are an IT professional or an advertising company, or you just don't have big assets? You rent your office, you don't have machines, so you can't borrow, right? Or what if you already use the asset to put a loan against and you need more money? Well, you're stuck. Lots of restrictions. You can't use the money for this. You can't use the money for that. You can't take another loan. It's terrible. And everything is done manually. Everything is done manually. So you're on a loan. You go to a branch. You can't go online. You talk to a guy sitting behind his computer. He's going to make many errors, so you have to repeat it 5 times. And then when it's done, it's not done. It goes to a central center where hundreds of people are looking at these documents, and they ask for more documents, and then back and forth, ping pong. It takes months before you get your money. Months. And in the meantime, your business might be failing because you don't have cash. So it's a pretty grim story. High price, high decline rate. OK. How come banks could get away with that stuff? Well, for many years, as we all know, banks had a good time. They had created this impressive system where, by putting branches everywhere in the country, and by making it pretty much compulsory to walk through the branches to have a financial relationship, by owning the bank data, which is quite critical to understand risks, they had a captive audience of people who had to go to their branch to talk to somebody to get the money, and they could only go to this branch because the next bank didn't have the data to underwrite them. So it was basically a closed-loop system with very little competition. And they were using that to cross-sell tons of products, which was very profitable. Now, there was a trick behind the bank that nobody realized at the time, which is this one. The way banks used to work, or kind of works today, is they lend money long-term, risky, like with some level of risk, but they borrow money short-term, typically through deposits, retail deposits, and so on, and they guarantee that this money has 0 risk. So there is no risk there. There is risk here. This is short-term money. This is long-term. And they tell you that it's all fine because there is this little thing here called capital that is going to take care of everything. Well, it's a bit of a joke, right? So they were doing what we call in banking maturity transformation. So short-term money becomes long-term money. So if people want their money, what happens? There is no money, right, available. And then they were doing risk transformation. High risk becomes low risk. They managed to do that for quite a few centuries. And it has worked well until the last recession, where people realized that this was bogus, and that pushed it so far that it was very, very risky. So what regulators did, rightly, is they told the banks, your tiny capital you're putting against this big system, you need to put more money now. Because when things go wrong, you don't have enough money. So that's very unsafe. So instead of putting like 4% of your balance sheet against this, what they call tier 1 capital, it's going to be 3 times that. Well, if you put 3 times more capital, but you don't make more profit, your profit as a percentage of capital shrinks. So your return on equity, which is the indicator that all investors look at to understand the return they make by investing on Lloyd's or Barclays or HSBC, it's melting. Nobody wants to invest in bank stocks anymore because they suck, right? And why wouldn't you put your money in Amazon or Google instead, right? This is terrible. 6% return on equity. Nobody wants that stuff. So banks, stocks plunged completely because of this change. So what did they do? Well, they wanted to rebuild profitability because they couldn't play with this capital, so they had to improve the margin. They shut down branches to save money, lay off people, put the customer service offshore, put some price increases here and there that nobody can see, and then tighten risk appetite. Just don't lend to risky people. Because the way the capital rule works under this Basel system you might have heard of, it's really penalizing small businesses. If you're a small business, because you're such a complex risk and it's a bit volatile, you're going to attract more capital than if you're a big business. So guess what? Banks have scarcity of capital. They're just not going to lend to small business anymore. They put all the money against big companies. So this change, which was there to protect the society, made it even worse for small business. So not only did they have a shitty service, but now they have a shitty service and they don't have access to money. Or it's even more expensive than before. Fortunately, there is another way. And it's called lending platforms. And I'm going to explain to you today why lending platforms turn this problem on its head and make it much better. But just start from the outcome first. On the left-hand side, you see cumulative lending, net lending to businesses in the UK. By net lending, we mean how much loans have been given to small businesses minus how much loans have been repaid. That's the net lending. Over the last few years, in the UK, net lending by big banks to small businesses is negative. So there is less and less money available in the system to help the economy through small businesses. Look at a company like Funding Circle. Our net lending is positive. We're growing 80%, 100% a year, and we keep adding more net lending to the system. So we're basically stepping in where the banks are stepping out. We're already playing in 4 geographies. We have around 900 people in the company. We've been around for 7 years now. Typically, we lend to businesses that are quite established. We don't do startups, right? I'm not talking about equity crowdfunding here. I'm talking about lending to established businesses. So we don't do businesses less than 2 years. Other guys take care of that. We focus on established businesses. And typically, those businesses borrow around 70 to 100,000 pounds. The default rate, on average, how much of the loan is not paid back every year? It's around 2%. So it's not a high-risk, subprime shit, right? It's the average of the economy. We're lending to the average guy who needs money. And we select good customers. And we are funded by a mix of retail investors, people like you and me putting some money on our website to lend it and earn a return. We also have institutions like public institutions. We have the European Investment Bank. We have the British Business Bank. So these institutions really like us because they think we're solving a macro problem, and they want to inject money in the economy through us, because banks don't do that. And we also have private institutions like pension funds and various kind of big funds who have to want to diversify the investments across this new asset class. Now, I'm going to tell you a bit how it works and where is data science in that stuff. Because there is a lot of data science behind it, as you can imagine. We're not doing it manually. Before, I like this little quote. I think this is exactly what we're doing, right? We need banking, right? The economy needs banking. Whether you like it or not, the world cannot function if there is no banking system that operates properly. But we don't necessarily need banks. Banks, the way I've described them, with these branches and this funny balance sheet and this kind of transformation of short to long and risky to non-risky, all these buggers, we don't necessarily need that stuff. But we need banking. And that's what we're trying to do. OK, so let me tell you a bit about how a lending platform like Funding Circle operates. Because it starts with the whole design, the system works differently. Funding Circle is a platform that connects small businesses and investors. So on the one side, you have people who want to borrow money. On the other side, you have people who want to invest money. We are the middleman. We're there to connect them, and we're there to do all the servicing. So we do the marketing of the loans. We select the borrowers to make sure we have creditworthy borrowers. We price the loans. We do all the money exchange. And then when the loan is paid back, we do the servicing, we do the collections, we do everything, and we take care of customers, both sides. The investors, every month, they earn the money that is repaid minus a fixed fee, 1%, that we keep for ourselves. So think about us like Airbnb or Auto Trader. We just connect people, right? It's a platform. And we take a fixed fee in the middle. This means that we don't have a balance sheet with loans. Right? We don't own these loans. They're not our loans. They belong to our investors. We don't tell investors that it's a risk-free proposition. It's an investment. They might earn 6%, 7%, or 0%, or negative %, depending on how things go. We'll keep them informed, and we'll be very transparent, but there is no guarantee. It's like buying stocks, right? Now, it's less volatile than stocks because you have a lending contract behind it, but it's no guaranteed. So the way it works is we don't do maturity transformation. If you invest on a short-term loan, you get your money back fast. If you invest in a long-term loan, you have to wait until the loan is paid back to get your money back. That's the way it works. We don't do risk transformation. If you take a risky loan, we'll call the loan A+, A, B, C, D, E. E is riskier than A+. You know that. You'll earn more. But we don't pretend that any loan is an A+ loan. That's a fact. So we basically completely changed the system where there is no black box. It's all transparent. And that enables us to move much faster. And we don't have to put tons of capital and all this complication of, we don't have provisions and capital and Basel and all that stuff. We're not subject to that. Our investors might be. But that's for them to take care of that with the data we give them. So to make this platform work very efficiently, we use a ton of data science. And this is where I think it gets really interesting. Remember, we have two clients. We have borrowers and we have investors. On the borrower side, we look at these borrowers from a customer relationship standpoint. So from the marketing stage to the first loan they might take with us to the further loan they might take, and we have a very high repeat rate because customers love the service, to potentially some of them going into collections and recoveries if they have some issues with their business. We look at the whole customer life cycle, and we optimize for the control of risk and for the creation of value together. It's a very integrated optimization system. And that's really important because many banks look at one loan. We look at the relationship over 5, 10 years because we expect repeat loans, and we optimize the price of the first loan, planning for the price of the second one, and all that stuff. It's a bit like, any kind of, it's like Airbnb, right? You know that people are going to repeat again and again. To do that, we have a bunch of tools. I can just give you some examples. The one that often people ask us for is, how do you underwrite small businesses using statistical scoring mostly instead of doing it manual? It's impossible. That's not true. It's possible. It's just hard. So we've developed some proprietary scores that are very, very powerful. And we've achieved that by spending a lot of time on getting the data and really harnessing the insights we get from them. But it's also about structuring those scores in a smart way. So I told you about the different dimensions of risk. Well, we have different scores for each dimension. So in terms of credit underwriting optimization, so we build different scores. So for instance, we score the performance of the loans that the business might have taken in the past. And we get data from commercial bureaus, credit bureaus. They give us data about historical payments and so on. That's the score. We have a score about the business itself, its industry, its what we call the firmographic, its age, its number of employees, and so on. It's quite interesting. We have another score about the owners of the business. Are they paying their debt on time? That's an interesting marker. We look at the financial of the business. We have a score for that. We look at the bank statement of the business. We digitize all bank statements. We do transaction level, machine learning, scoring. Then we do the correlation between those. And we do meta scores, where you take the scores, you weight them dynamically, and you get to a higher level of scoring. So by getting to the system of multiple modules, aggregate it, and then scores run at different point in time in the application journey. So the more the information comes in, the more we improve the Gini of the score, and the more we can refine the decisions of risk, acceptance, yes, no, pricing. So this optimization system works. It's just complicated. Banks never try to do that. So it's possible to do it. And we've been doing that for many years now. But we also apply good data science when it comes to marketing. So we do, for instance, micro-targeted marketing. We use multiple channels like emails or web, direct mail, telesales, a mix of channels. Because small business entrepreneurs, they are in their 40s, 50s. They don't necessarily are all on Facebook, right? So you need to use a mix of traditional and more digital channels if you want to reach the whole breadth of them. And we do optimization of how much money we put against each channel, how we rank out of the opportunities, how we do, obviously, the response attribution, how we optimize for the risk of the responders of different channels, depending on the level of marketing we do. So there are so many interactions that if you get it right, if you understand that, you can make the borrower experience much easier, because when they're at the door, you kind of know already the quality of them and their price sensitivity and all that stuff. We do, obviously, account level lifetime valuation. So instead of looking at one loan, we look at the series of loans, and we do the net present value of the relationship, and we optimize the cash flow, doing activities around pricing and marketing. Very often, I'm asked about how is this business going to fare in a recession? Right, fair question, right? Lending is a cyclical business. Well, we do account level stress testing. So we stress the risk level of those borrowers, and we ensure that the price we charge is going to be sufficient to preserve positive returns in bad time. And we continually review the performance of the book. And every month, we make adjustments by sector, region, any kind of pocket where we see deviation. We adjust our scores to rectify and make sure the returns are aligned with what we promise to our investors. And because it's a replenishing business, if a cohort of loan is not great, we can make the next one better, and it's going to replenish the book. And our investors invest in a passive way. So basically, if you open an account with Funding Circle, you put £2,000, your money will be reinvested. As the loans come back, there is an auto reinvestment system, which you can turn off anytime. But if you do that, you benefit from the fact that the new cohort is corrected based on the performance of the previous one, and we continually rectify the asset so that the portfolio is kept very stable. We put a lot of data science in optimizing our processes as well, because it's not a fully automated system. Small entrepreneurs, we found they like to talk to somebody. They need a bit of guidance. They're not very educated with finance and so on. So they really appreciate the human touch. So we give them the chance to talk to one of our staff. We also have manual underwriters who deal with complicated cases, exceptions, big loans. So there is a way for us to refer complex things to people who have the expertise. But we do that in a way which is optimized. So we have algorithms that look at the incremental value of adding a human touch. And we would push applications through different tracks based on the marginal contribution of the marginal investment of the human touch. I think that's really cool, right? For me, that's the model of the future, where you deal with the hybrid of human and machine, but the use of human is considered based on its incremental value over the non-human treatment. And if you do it this way, you're not going to eliminate all jobs, like people say. You just use people where they add value. And it makes that job more interesting as well. So think about, sales. Why should you make this phone call? Is it worth it? Or is the customer going to complete his application anyway? Or do you, in some cases, let people call you if they need to? Or do you call them proactively? And you can make optimization on that. And we do machine learning optimization on these things. So this results in a process which is, I think, quite different from the banks. Typically, our borrowers go online, they apply for a loan, they fill a questionnaire. As soon as they give us their company number, we can pool data from many sources, and we run 5 scores in a nanosecond. And we rank order them on a risk basis, propensity, price sensitivity basis. We eliminate the very risky loans, and we can give them a first quote pretty much immediately. we ask them still to provide some more information because we don't have yet everything online. So we ask them for their latest financials and their bank statements. And this goes into a secondary stage where we do a secondary set of model to optimize further. And this is where we have this selective manual review where we think there is a need for. But the whole process takes around 24 hours. So within the same day, people sometimes can have the answer or they have it the next day. We've surveyed our borrowers. Why, asking them, do you like it? Our net promoter score, delta between people who would recommend us and people who would not, 89, the max is 100. Banks are -5, -10, right? This is like, I think, higher than that. You have Tesla, although it might change because people are tired of waiting for their car. But they usually have good results. But this is higher than Mercedes or it's higher than Apple. This is pretty good. But it's not that we are geniuses. It's that the alternative is so bad, right? That if you do something good, you look great, right? But we need to make it better because at some point banks will wake up. But people come to us because it's fast, simple, the interest rate was fair, and they just hate the banks, mistrust by banks, and all this brand issue is a big issue. They like the sense of community. We treat them like people we respect. Now there is something behind that is the data. We've created probably the biggest data set around small businesses you can find in the UK, and in every market where we operate, that's what we do. So we're obsessed about data. We buy tons and tons of data from different data sources, and then we have a great data team spends their time knitting these pieces together. This is hard. How do you stitch all these parts that are not exactly aligned because they come from different sources, but you create this deep learning mega base? Because when you have all the SMEs in the world in a base and you connect everything together, and you have good data scientists to make sense of it, there is no chance any bank can catch us. That's what we do. We aggregate credit bureaus, consumer bureaus, commercial bureaus, company house data, financials, company registry, our own marketing tests, performance data, the financials they give us, the bank statement, we digitize everything. Everything goes into this big pot, and it's all normalized, connected, and so on. Now, the new frontier for us is bank data. You might have heard about open banking. Banks have to API their bank data out. You might have heard about PSD2, which is the same thing in continental Europe. And then you have all these APIs like Yodlee and Plaid, all these guys who help you doing screen scraping, which works in the US quite well. We're doing that stuff. And our intent is to do it more and more. Basically, when people come to us, we suck all the data, from their bank account. We basically have more data than their bank because we have all their bank data plus data from other parts that banks don't bother looking at. So we end up with a better data set to price, to decide, to automate. That's the main competitive advantage. It's very hard to reproduce. In our data set today, we have around 20 million companies between the UK, US, Germany. We've done more than 10,000 experiments. We've tried different price points, different marketing tests, all these experiments are recorded. It's like a huge pharma company, where you test molecules all the time and optimize and optimize. And that's the point of it. It's the learning cycle. The more we book customers, the more we create loans, the more we accumulate behavior data, the more we can train the models with richer data, bigger data sets, and then that means we can accept more, we can lower the price, because that preserves the net yield for the investors, and that means we can market deeper, and then the whole thing accelerate and accelerate. That's why we've been growing so fast. People were asking me, do you grow at the expense of the investors? Are you guys just booking shit to get bigger and bigger? It's actually the opposite. Our loss rate keeps coming down because we feed the models with more and more good data. That means the models, the Gini, the risk premium of the models keeps getting better and better. And that's how we're going to solve this problem. Now, I've talked a lot about the borrowers, but obviously we're a platform. We have another side, the investors. Guess what? We do the same with investors. We optimize for them as well. Over the last 5 years, 6 years in the UK, our investors on average have earned 6.6% per year. 6.6% per year. I don't know if you know, maybe you didn't bother, how much your bank would give you if you leave your money in any of their product. But I think it's going to be sub 1%. I mean, if you get 0.5, you should be quite happy. And then your money is probably blocked for, I don't know, a year. And it's terrible, right? Same shitty experience. Again, 6.7. Now, it's not guaranteed. The future might be different from the past and all these good things. But the fact is, over 5 years, people have earned 6.6. It's great. Think about, pensioners and so on. We're not making any money on their savings. This is a game-changing thing. And our investors are so happy that they keep reinvesting. So 80% of the money we use to fund loans comes from investors who've already put money before. Either the same money being recycled, or it's actually new money that they keep pouring in because they're so happy with it. And it's true of retail investors. We are supervised by the FCA in the UK. They keep us very honest. They check all the numbers. But also institutions. We have these big funds and BlackRock and Railpen, and these guys are really smart, and they keep us honest. So when they like it, it's that they really know what they're doing. Behind that, there is a lot of thinking going on as well. An example of that is we have this system. The way the system works basically is the loans come in, and for the retail investors, we want to reduce the risk of concentration. We don't want one guy to put all his money on one loan, because even if our risk models are good, there is just this risk of lack of diversification you can't do anything about. So when the loans come in, we dice them into small parts like mini bonds, and then those parts are allocated to each investor portfolio. And we've given retail investors in the UK the choice for, do you want a conservative kind of investment where you only pick the top low-risk loans, or do you want like an average? So they can choose the level of blend. But we create small parts, and we put them in their portfolio. And at no point in time do they have their portfolio exposed more than 0.5% to the same company. So we force diversification to make the returns very stable. Investors have a choice to wait for the loan to repay, or they can action the sale through the secondary market. So we actually have an exchange. It's a pretty big exchange we have. People can sell their parts to other people who are happy to take them before the loan has fully amortized, so they can get their money back quicker if they want to. It's not guaranteed. You need to have enough liquidity, but usually it happens within a few minutes. They resell the parts come back, and we have an allocator to reallocate the parts to everybody's portfolio. And we don't do just randomization. We do optimized randomization. So we have calculator to make sure that every customer is going to get a mix which will converge the net yield to the closest possible to the mean of what we've promised for conservative versus balanced. So it's an optimization of the constraint system. It's quite complex. We process around 1 million transactions a month. So it's a tiny business today, Funding Circle, but it's a big machine. It's like the London Stock Exchange, right? It's a lot of movement and a lot of good science behind it. And just to close, I would say it's a very exciting mission. Data science plays a big role, as you see, and technology as well. But at the end of the day, it's about the people. And having worked in financial services many years, I absolutely love it at Funding Circle every day. And the reason is the diversity of people we have there is really cool. And it's not just male, female, or whatever nationalities. It's the kind of people, their background, their way of thinking. I really love that. This is my kind of image of it. You have in the same room. That's real. We do that every day. Yeah. Somebody who might have worked in a bank as a commercial underwriter, traditionally understands underwriting loans, paired with a data scientist who might have worked at Amazon or Google. We have an investment banker because he needs to sell those loans to big institutions. He needs to understand how it works. We might have an e-commerce expert on how is the customer experience going to work, a digital marketer, a data engineer to make sure this data is properly structured. These people in a bank would never meet. Never. Because some of them would never join a bank to start. And if they do, they don't talk to each other. They are in different silos. They hate each other. If you ask this guy, he hates these guys. Because this guy is making 20 times what he's making, right? And then this guy thinks that this guy is an idiot, right? So, well, here, because people are aligned to the purpose and to the mission, and they love it, they join us, and they work together, and they learn from each other. People ask me, do you need to be an expert in banking to join Funding Circle? No, not at all. Do you need to know credit risk analytics? No, we have many types of analytics. If you want to learn credit analytics, it's cool. But there are other skills we would be interested in. If you're really good at data science, wherever your background, that's great. Let's talk about it. So just going to leave you with the final quote. You know, Steve Jobs, you need to be a bit crazy to change the world, right? And had you asked banks 10 years ago, could this system ever happen? They would have laughed at us, right? Pre-recession, 10 years ago-ish, they would have thought, no way. And the truth is, 10 years ago, the algorithm we're using to run this data could not work. I tried that when I was at Barclays. Some of these things we do, crunching this 20 million database, the computer would just crash, right? The machine learning models we use for direct mail and so on, where we run through these huge iterations, it would take weeks. Now it takes us minutes. And that's why it's possible today. That's why we're going to solve this problem. And I'm very glad we get there, because I was really pissed off with how bad it was before. Thank you, guys. We have time for a couple of questions. There is a mic as well. Yeah. Anybody else? OK, over there. You're going to? OK, thank you.
Hi, thank you. Great talk. When you make a decision for a small business, how open are you? How open do you have to be with them about the reasons for a decision in terms of what's driving the algorithm to a yes, no, or an approval rate? And is there anything coming on the regulatory horizon that might affect how open you have to be with them about the reasons for a decision?
So there is no obligation, but that doesn't mean we don't want to do it, because we think it actually helps in the relationship. So what we do is we run models, but then as an output of the model, we always surface the top 3 positive and the top 3 negatives. And we turn that into a language that is understandable by our customer service people, and so that they can relay the message to the company, and the company can understand what they need to do. So for instance, sometimes they're just too young, or they didn't file their accounts, or there might be things that they can fix. So it's actually helpful, and then they come back, right? Regarding the last point, I think you're touching on, are we doing things that could be questionable and so on? It's something for which we have a very high bar. So we look at the variables we put in the model, and we check that they wouldn't create any kind of reputation risk, and they are justified and so on. And we eliminate those that would not. We also supervised by the FCA, and they rightly challenge us that we're not doing anything we should be ashamed of, and we don't, right? So the markers we have are things you would expect, variations of cash flow on bank accounts over many months, crossed with the financials, crossed with number of arrears on debt in the past, and this kind of stuff, right? We don't grade people based on anything like their personal identity, their religion, or any kind of crap like that. We never do that. We're in a trust business. Our investors don't want to be associated with anything that stinks, right? So and they do due diligence on us all the time, because the loan is theirs. So if we do anything wrong with the loan, they carry the reputation risk, and they really don't want that. Well.
Hi, thanks. Great talk. You mentioned at the start that equity crowdfunding is not on the table. In terms of models and technical side and on the data science team, is that something you might go into someday, researching models on actually equity rather than loans?
It's not on the plan today. I think similar solutions could apply and could work. I think it is quite different, though, and it would require a lot of work. So I wish somebody does that and does it really well, because, frankly, that would do step 1, and then we could do step 2. But for now, we'd rather focus on what we do well. Because you can see this is about deploying an expert solution, right? We're a niche player. And having this degree of focus is really what makes us better than banks. If we dilute our effort, we might not be good anymore. But so I don't think we're going to pursue this one, although it's quite exciting as well.
I'm afraid this is where we have to stop, because the next speaker is already ready and turn around. There's lots of people who want to come in.
OK.
Thank you very much.
Thank you very much. Thanks.
Thank you.